Hi there, and welcome back to another video from Peter Bats International Group, where we talk about different topics relating to accounting, tax, businesses, and so on and so forth. So, in this video today, I would like to talk about business valuation, like how do you value a company? Now, the topic of business valuation is frequently discussed in corporate finances. So business valuation is typically conducted when a company is looking to sell all or a portion of its operations, or it's looking to merge with or acquire another company. So the valuation of a business is the process of determining the current worth of a business by using objective measures and evaluating all aspects of the business. So it's an important question for any entrepreneur, business owner, employee, or even potential investors for any size company. Now, understanding your company's value becomes increasingly important as the business grows, especially if you want to raise capital, sell a portion of your business, or borrow money from the bank. So in a simple statement, a business valuation is a general process of determining the economic value of a whole business or a company unit. Now, in that sense, business valuation can be used to determine the fair value of a business for a variety of reasons, including sale value, establishing partnership, taxations, and even divorce proceedings. Owners will often turn to professional evaluators or professional business evaluators to evaluate or estimate the values of their assets or how much their business is worth. So, depending on your type of business, there are different metrics that are used to value either a public or a private company. So, we look at it in two perspectives: public companies or private companies. It doesn't matter. For public companies, valuation is referred to as market capitalization, where the value of the company equals the total number of outstanding shares multiplied by the price of the shares. Public companies can also trade on book values, which is the total amount of assets minus liabilities on your company balance sheet, which is a different topic that we will talk about in the future. The value is based on the asset's original cost, less any depreciation, amortization, or impairment cost made against the asset. On the other hand, we look at private companies or private company valuations. Private companies are often harder to value because there is less public information out there, a limited track record or performance, and financial results are either unavailable or might not be audited for accuracy. So, with all that said, there are 5 important metrics to look for when you are trying to value a company. Number 1 is the company size. Of course, you want to know the company size. Company size is a commonly used factor when valuing a company. Typically, the larger the business, the higher the valuation will be. This is because smaller companies have little market power and are negatively impacted by the loss of key leaders. Now, in addition, larger businesses likely have a well-developed product or service, and as a result, they have access to capital much more easier. That moves us to number 2, which is profitability. Now, you ask yourself, is your company earning a profit? If so, that's a good sign, as businesses with higher profit margins will be valued higher than those with low margins or profit losses. The primary strategy for valuing your business based on profitability is through understanding your sales and revenue data. Valuing a business based on sales and revenue uses your totals before subtracting operating expenses, multiplying that number by an industry multiple. So let's say, for example, your industry multiple is an average of what businesses typically sell for in your industry. So if your multiple is 2, companies usually sell for 2 times their annual sales and revenues. And that moves us to number 3, which is market traction and growth rate. When valuing a company based on market traction and growth rate, your business is compared to other competitors. So in that case, investors want to know how large your industry market share is, how much of it you control, and how quickly you capture a percentage of the market. So the quicker you reach the market, the higher your business value will be. And that moves us to number 4, which is sustainable competitive advantage. So you ask yourself, what sets your product, service, or solution apart from your competitors? With this method, the way you provide value to your customers needs to differentiate you from the competition. If this competitive advantage is too difficult to maintain over time, this could negatively impact your business valuation. And in another sense, a sustainable competitive advantage helps your business build and maintain an edge over competitors or copycats in the future, pricing you higher than your competitors because you have something unique to offer. With that said, that moves us to number 5, which is future growth potential. Is your market or industry expected to grow, or is there an opportunity to expand the business product line in the future? So factors like these will boost the valuation of your business. If investors know your business will grow in the future, the company valuation will be higher. The financial industry is built on trying to accurately define current growth potential and future valuation. All the characteristics that I have listed, or all the metrics that I have listed earlier on, must be considered when valuing a business. The key to understanding future value is determining which factors weigh more heavily than the others. So with all that said, we hope you enjoy watching our videos. And if you do, don't forget to subscribe for more future videos relating to business valuations and other topics that are related to taxation, accounting, and auditing. Thanks for watching and have a pleasant day.